Overview. Loans are a guarantee for students who fill out a FAFSA application. Federal loans come in two forms of subsidized and unsubsidized. The loans are almost identical in having a fixed interest rate, federal repayment options, no requirement for a cosigner, and a 6-month grace period. The primary difference between the two is that the unsubsidized loans will begin to accrue interest immediately after they disperse, while the subsidized loans will stay at the principal balance for the entire duration of the loan until the grace period is initiated. Subsidized loans are considered needs-based, while unsubsidized loans are not. Please keep in mind that undergraduate students will need to be enrolled in at least 6 credit hours at all times to prevent the initiation of their grace period or to qualify for the loan in general. Students will have different levels of eligibility based upon their credit hours. In order to fully understand eligibility, it is important to properly define dependent and independent. In general, individuals become independent once they become 18. However, the FAFSA analyzes dependency differently. When students complete the FAFSA application, they will have a dependency section that asks specific questions. To simplify whether or not a student will be classified as a dependent or independent, review the following. Is the student serving his active duty in the military? Is the student married? Is the student 24 years of age or older? If a student is able to answer yes to any of these questions, it may indicate that they can qualify as an independent student for federal aid purposes. The main takeaway from this is that even when a student is self-supporting and 18, it does not automatically classify them as an independent. Federal Stafford loans. First-time freshmen will be offered a total of $5,500 in federal student loans. New borrowers will need to be aware of a couple requirements they need to complete. Those requirements are the Direct Loan Entrance Counseling and Master Promissory Note, or the MPN. The Direct Loan Entrance Counseling is an assessment that guides borrowers through the obligations and responsibilities they must uphold for their federal loan. This requirement can take 10 to 15 minutes to complete, and it will require the student to be proactive and engaged while taking the assessment. Throughout Direct Loan Entrance Counseling, students will be required to respond to short answer questions that review their understanding over specific sections. The MPN will obligate a borrower to repay their loan once their terms are complete. The loans have origination fees connected to them that will be deducted from the overall loan amount. However, students will still be obligated to pay back the full amount of the loan since the fee is the price they pay for a disbursement. Once a student takes out a loan and it has dispersed their account at SUU, they will be assigned a loan servicer that will collect payments on behalf of the government. Federal subsidized and unsubsidized loans are entirely in the student's name, and parental information is only used for eligibility purposes. Loan servicers are obligated to contact students via email once a loan has dispersed to their account. Students will be able to make payment arrangements and review their terms with their loan servicer. Students can find loan servicer information by logging on to studentaid.ed.gov or through the My Student Aid app on their phones. Once they are on the site, they will be able to log in with their FSA ID to see any loan amount that has ever dispersed in their name, as well as contact information for their loan servicer. New borrowers will not be able to access that information until a loan servicer is assigned. It is understandable that some students might be confused why they are unable to request loans past their yearly limit. This is where some students may be able to request a Parent Plus loan. Students are able to request a Plus loan through their parents by filling out a Parent Plus loan application that is online. The Parent Plus loan is another type of federal loan that can be applied for through the FAFSA. The key is that the parents have to apply in order to receive this loan. The loan can cover expenses up to the cost of attendance and disperses towards a student account in the same manner as other loans. However, through the application process, parents will request the loan on behalf of their students, and the Parent Plus loan will be in the parent's name only. If families are opting to take out a Plus loan, they will need to understand that the loan is more traditional and akin to a private student loan. Interest will begin to accrue on the loan immediately after it disperses to a student account, and parents will be responsible for making payments 90 days after the initial disbursement. Usually the loan is at a higher interest rate that is set each year. In order to be eligible for a Plus loan, the request must come from a biological or adoptive parent of an undergraduate dependent student. There are certain scenarios where a Plus loan may be the most optimal option for a student. In instances where parents do not meet the requirements for eligibility and the loan application is denied, a student may qualify for more loan funding. Send these students to the financial aid team. Also, parents who are approved on a Plus loan can make arrangements with the loan servicer to set up a deferment of payment options while students are enrolled in school. When setting up a deferment through the loan servicer, it will be able to follow a similar trajectory for federal undergraduate loans with a 6-month grace period once the student has graduated. The PLUS loan is not able to be requested for independent students, and funds will be applied to an account in the same way as other federal loan options. Private loans. Certain populations of students may opt to request a private student loan in addition to or in place of federal student loans. Private loans are very similar to the PLUS loan, but are requested from various financial institutions. Financial institutions consist of different banks or credit unions that have potential borrowers fill out a student loan application to be considered. Private loans can help to cover up to the cost of attendance and will depend on multiple factors. When completing a private student loan application, financial institutions will assess credit to determine how much a student can borrow and under what terms they can borrow. Most often, the loan will be requested under the student's name with a cosigner to determine eligibility. When considering a loan, borrowers should understand the following. 1. Interest rates. These are important since financial institutions that are private are not backed by the government. They may not offer a fixed interest rate. It is important for students and families to search for loans that give them a fixed low interest rate. If a fixed low interest rate is not possible, then they should focus on understanding the variable interest rates of their loan and make a plan for future payment. Number 2, terms. Many private student loans will have varying repayment schedules that do not fall in line with the federal system. Most institutions will allow students to set up payment options once a student has graduated, and it is important to understand the information before accepting a loan. 3, fees. Like the origination fees attached to the federal student loans, there may be times where the fees of private student loans outweigh the benefits of a loan. Potential borrowers should always review their contracts to make sure they are fully aware of any additional financial obligations outside of the initial loan amount. And 4, limits. Different limits will be imposed based on the financial institution's rules and also dependent upon a borrower's credit. If a student is in a situation to request needed funding, they should ensure that they are able to get the amount that they need. We have a responsibility to educate students about the federal student loans before they request private student loans. Often, families have a misconception of what federal student loans are, but they are typically better than any private loan offered. Students wanting more information or additional options for private student loans should be sent directly to us. You should never recommend any banks or financial institutions to a student, parent, or family. Yearly limits and adjusting loans. Each credit level, a student will have a specific limit based on their academic credits achieved. This is displayed in the eligibility chart we reviewed previously. The only time the yearly limit may shift is when a dependent student is denied on the PLUS loan. Aggregate limits may come into question for certain families that want to ensure they have funding over the next few years, and for transfer students looking to transition into a graduate program. Yearly limits can also be used during the spring and summer terms if a student did not attend another institution in the fall. Their eligibility for the year can be doubled within one semester as long as it does not exceed the cost of attendance. There will be times that students need to adjust the aid listed on their account. A student may have a situation where they want to increase or decrease the amount of their loan or cancel their loan altogether. These situations should be elevated to the financial aid administrator. How will conversations go with loans? Students will ask you whether or not they should take out loans. A good starting point to communicate to students that they can afford to attend SUU is to highlight their loan opportunities and why it benefits them. In Utah, students are extremely hesitant to take out loans due to misperception or fear. Some students will do everything to avoid loans, but delivering relevant information to help them understand them is more important. You can emphasize the key points as follows to help students change their perception and feel better about the loan process. 1. SUU has low student debt upon graduation. 2. The amount of funding you request each year would be an investment into your education. 3. Taking time off work instead of attending could hinder your earning potential since the government is providing an opportunity to invest in education. 4. You have a 6-month grace period once you drop below 6 credit hours before you have to start paying back your loans. And 5. You can specify how much of your loans you want when accepting them each year, and you can make early payments without penalty. Also, realize loans may not always be the best option for students. Never push loans onto a student and set up an appointment with a financial aid team if students need a deeper review.